Good morning. My name is Doug Ray. This is the Wealth Guardian Show right here on 94.5 WPTI, the Piedmont's News Talk and Sports Station. So if you're retired or even knocking on the door of retirement, this is a very difficult time. Every day you turn on the news or open up the paper, there's another piece of bad news in it. And even if it happens halfway across the world, it impacts our stock market and our economy. But let me ask you something. Are things really that different today? Or is it just the same old stuff that we've been seeing all of our lives? You know, I did some research, and what I found out was pretty interesting. Back in 1982, we fell into a severe recession. By the end of 84, over 70 U.S. banks had failed. In 1985, a TWA flight was hijacked by Hezbollah. In 1987, there was Black Monday, the largest one-day drop of the Dow Jones in history. Stocks were down nearly 23% in one day. In the 1990s, we had Operation Desert Storm. We entered a major recession. Islamic fundamentalists bombed the World Trade Center. And in 1999, the Dow climbed to over 11,000 for the first time. This doesn't even mention what happened in the 70s, and of course, we're not even talking about what happened in the 1920s and 30s. Folks, the point I'm trying to make here is, while it seems like it's different, it's not. We've been through bad times before, and we'll get through them just like we did before. You know, I started this show 8 years ago for one reason, and that's to help you guide yourself and your retirement through times that I felt like were coming, times like right now. I even named the show the Wealth Guardian Show because of that sincere desire to try to help you through these coming tough times. Now, before I get into today's show, I want to do a couple things today. Obviously, the first thing I want to do is I want to throw out a big old thank you to our men and women in uniform who serve every day in harm's way to protect us. Thank you so much. I like to do that on every show. Let me give you a rundown of what we're going to cover today. I'm going to open up with market comments because much has happened in the last few weeks, and I want to bring us up to speed on that. Then I'm going to get into a case study, something that I have uncovered this week, meeting with a client, and it's, in my opinion, unbelievable. An 86-year-old widow invested up to her eyeballs in risk assets, and we're going to talk about that in a moment. But first, let's delve into the market. And by the way, I want to also invite you on our website, www.thewealthguardians.com. I've got a lot of great information on there that you can read and print off and take down about retirement planning and how to keep your money safe. The other thing I want you to do is go on Facebook and like us there, Wealth Guardians Radio Show on Facebook. We try to update that every day and use a little bit of humor on Thursdays as well, so it's kind of an interesting place for you to take a look. Let's talk about this market update. You know, the first of the year, I opened up the year with the show that basically is kind of a tongue-in-cheek show that talks about different market barometers. And we talked about things like the Santa Claus rally. We talked about the first 5 weeks of trading in January. We talked about the January barometer. And then I ended it up with the Super Bowl barometer because that one to me has always been interesting because, believe it or not, it has an incredibly accurate track record. Well, we finished up January, and both the January barometer, the Santa Claus rally, and the first week of trading in January were not good to us. In fact, all of them indicate a negative market year. In fact, this January barometer, which basically says as January goes, so goes the market, we had the worst January in stock market history. Not good. And then, of course, the Super Bowl barometer. Oh, my goodness. We know what happened now. The Denver Broncos beat the Carolina Panthers. And I didn't think that would ever come about. I really didn't. But old Peyton Manning, he sure had something up his sleeve. So the Super Bowl barometer predicts that we're going to have a negative market year because the Denver Broncos are an old AFL team. And when an old AFL team wins, we have a negative market year. It's accurate 87% of the time. It worked last year. Now, it doesn't indicate how bad the market's going to be. It doesn't indicate severity, but it does indicate up or down. So we got that going for us this year. Well, we're down since last May's high. We're down about 10, 11% in market indicators. We're very oversold on the weekly charts right now. A little bit overbought on the daily chart. We're overdue for a nice bounce here. Now, the question becomes, do you buy the dip or do you sell the bounce? Now, if you listen to my friends on CNBC, they're screaming at you to buy the dip. That certainly has worked for about the last 6 or 7 years. But there comes a time when buying the dip doesn't work, and I think we're at that point in time. My opinion is you need to get cautious. You need to sell the bounce. So when do you sell? How do you get cautious? Let's take a look at some things. Typically, if we are entering a bear market, which I believe we are, what you're going to see on these sell-offs and then the coming bounce is we have retracement levels of anywhere between 33, 50, and 67%, and even sometimes it can be 100% retracement. I don't think we're going to have anywhere near 100% retracement, but we could have a 50% bounce back, which basically means right now we're currently at about 16,000 roughly on the Dow. That means if we get a 50% retracement, we could go up to between 17,000, 17,500 on the Dow. If that happens and we start to roll over again, then that would be a great, great time for you to consider lightening the load up. Now, let me do this. Let me invite you in to sit down and let's talk about this. Have a second opinion. All you have to do is give us a call at 336-391-3409. I'll show you on the charts exactly what I'm talking about, how to protect yourself, and be able to take some of the risk off the table when we have this next bounce, because I believe that we're going to have a very severe market this year. Now, if you just joined us, we're talking about the market and how 2016 is shaping up, and I want to get into some of the reasons why I think we're going to have a pretty rough go ahead. Let's take a look at the fundamentals first. Corporate earnings, corporate sales are declining. The unemployment rate, even though that's been touted as a big win for, the Fed and the administration, folks, those employment numbers are bogus. Absolutely, totally bogus. There is no way we have a legitimate 4.9% unemployment rate. It's one of the biggest snow jobs I have ever seen come out of this U.S. government. And statistics can be manipulated any way you want them to be, and they are doing a heyday on manipulating these statistics. We have stagnant wage growth. Oil. Listen, oil, right now you're benefiting from that because the prices of gasoline is down. But oil, the low price of oil is really hurting a lot of businesses out there, especially the newly created oil industry in the United States. And also the fact of the matter is the savings that you're seeing in the price of gasoline is not directly translating into consumer spending. If it was, we'd have a little bit of an economic boost, but it's just not happening. Apparently what you folks are doing is you're saving it or you're paying off debt, which, hey, I applaud you for that. Japan. Let's look at Japan. Last week, Japan went to negative interest rates. And what did that do for them? Their Dow, the Nikkei Dow, since that announcement has sold off about 8%. And guess what Janet Yellen said? This week, Janet Yellen said to the banks to prepare for negative interest rates. Now, what does that mean? That means this, folks. That means if you put $1,000 in the bank, a year later, you're going to get back $997 or $995 or whatever the case may be. You'll actually get back less than what you put in it. That's negative interest rates. Now, what's that saying about the economy and the markets? they had the audacity to raise interest rates last month because they said the economy is doing so well. And now they're talking about negative interest rates. I don't really think they know what the heck they're doing up there. All right, let's talk fundamentals. Technicals. The technicals of the market look even worse than the fundamentals. We're in a confirmed downtrend. We're below the 50-week moving average. We've had a monthly death cross. The advanced decline line gets weaker and weaker all the time. And, of course, as I've told you before, my friend Tim Wood, his 5 DNA markers have lined up, and they have been perfectly accurate predicting the major market tops since 1896. So, my advice to you is yes, sell the bounce. Do not buy this dip. You need to get protected. You need to save yourself from what I think is going to be a major bear market coming up, and we are certainly overdue for it. Now, I've got some great ideas to help protect you and set up your retirement plan, and I'd love to share them with you. Again, I want to invite you in to come in and sit down and talk with me, and let's get a second opinion about what you're doing. Just give us a call at the office at 336-391-3409, and let's take a look at your portfolio. Coming up in the next segment, I'm going to tell you about a case study that I ran across this week. I was meeting with a client, and she is concerned about her 86-year-old mother, and rightfully so. This poor lady is up to her eyeballs in risk, and I've run across situations like this in the past, but this one even surprised me. So that's coming up in the next segment. Well, thank you so much for tuning in today. This is the Wealth Guardian Show with Doug Ray on 94.5 WPTI, the Piedmont's news, talk, and sports station. And we'll be right back in just a minute. This is the Wealth Guardian Show. My name's Doug Ray. It's 94.5 WPTI, the Piedmont's news, talk, and sports station. Today, we've been talking about, is it different this time around than it has been in the past? I'll put forth to you that while things seem to be different, they're really not. The cause and effect may be different, but the ultimate outcome are going to be the same. We've been through tough times before. We're going to be going through a tough time, in my opinion, here very soon, but we'll get through it just like we have before. My whole goal is to help guide you through what I perceive to be a pretty tough 2016 coming up. Now, let me ask you this. How will the turmoil on Wall Street ultimately impact your money and your retirement? What should you do with your money right now, if anything at all? And what are your options? What can you do? Maybe you have no retirement game plan. Maybe you need a second opinion. Or maybe you think you're on the right track, but you just need some confirmation of that. One thing's for sure, this is no time for complacency. Whether it's us or someone else, you need to take control of your money. Otherwise, you could find yourself in a lot of trouble. Find out how you can take control with our 5-point retirement master plan. Your initial analysis is not going to cost you a penny. You got nothing to lose. And you'll discover what a profound impact this plan can have on just how far your money can go in retirement. If you're retired now, or you're within 5 years of retiring, then give us a call. Let's schedule that customized 5-point retirement master plan. It's a written plan. It's a roadmap for you. It'll give you peace of mind. We've helped hundreds and hundreds of people here in the Triad to be on the successful right track. So call us at 336-391-3409. Now, if you've been a listener of my program for a while, you've heard us talk about rules of thumb and several things, one of which is we call it the rule of 100. And I'll tell you, I really wish the rule of 100 would be adhered to by most folks, because that simple little rule of thumb will keep a lot of people out of so much trouble in their investing. It's amazing. If you've never heard of the rule of 100, here it is. Basically, it helps us allocate risk in your portfolio. Bottom line is, you take your age, you subtract it from 100, and let's say you're 60 years old. So obviously the answer would be 40. What that represents is that at a 60-year-old, no more than 40% of their total portfolio should be in a risk asset. Now, what that does is, if you believe that as we get older, we ought to be safer with our money, then it just takes our foot off the accelerator slowly as we age. It's common sense. Now, this past week, I sat down with a client. She's been a client of mine for, I guess, 3 or 4 years. She's about 62, and she's in great shape. We've got her in some in some programs that no matter what happens, she's not going to be able to lose money. But when markets go back up, she's going to be gaining money like she did the last couple years. The question became about her mother. She's very concerned about her mother. Her mother's 86 years old, and she's in fragile health. She has a brokerage account. She has almost $1 million at a major brokerage firm. And my client asked me to go meet with her mom, and I did so. I did it. It was early spring of last year when I first met with this lady. And I didn't know what to expect. She is a very wonderful lady. I mean, looking at her, talking to her, you'd really never know she was in fragile health. But unfortunately, she is. So she was concerned about her portfolio as well. Because in 2008, she told me, quite frankly, she said, I lost $200,000 and I never have regained it. And I said, well, let me take a look at what you have here. And as I started looking at her portfolio, I was appalled at the level of risk. Now, let's go back to my rule of 100. If you're 86, that says that no more than 14% of your portfolio ought to be in a risk position. That's prudent. Hers was nearly 100% at risk. And it is a managed account, a fee-based account in mutual funds. I know the broker that manages this account. I've known him since my brokerage days, back in the late 80s and early 90s. I don't understand his thought process here. It's a managed account. It could be managed a whole lot more conservative. He's not going to make any more money managing it conservatively as opposed to managing aggressively, so it's not a money issue for him. But I looked at her portfolio, and she had things in there called high-yield funds, dividend income funds. And let me tell you, if you don't know what a high-yield fund is, that's just a misnomer. It's a name for a junk bond fund. This lady, an 86-year-old, had about 30%, $300,000 in various junk bond funds. Now, if you look at the junk bond market, the junk bond market's in chaos right now. It's down about 20%. Why? Well, what are junk bonds? Junk bonds are bonds issued by corporations who are either early-stage companies, young companies, companies that carry the most risk. Now, if we dig deeper into the junk bond market right now, what companies have a predominant amount of their bonds in these funds? It is the oil frackers and the oil shale producers. And guess what? The reason why these junk bond funds are collapsing is because these companies cannot make a profit unless we have oil around $60 or higher. $50, $60 or higher. Oil right now is under 30. These companies are going to go out of business. They're not going to be able to service their debt, and their bonds are going to fail. That's why these junk bond funds are down 20% or more. Now, I started looking at her portfolio even further. Dividend income funds, rolled income funds, a lot of income plays here, right? They all sound pretty and nice and wonderful, but they're basically equity-based. Yes, there's blue chips in there, but you know what? Blue chips are going to go down. And a lot of these blue chip companies were the companies that are everyday companies. Exxon, British Petroleum, Chevron, oil-based companies. Companies that have historically paid nice dividends. But they're getting killed right now because of oil prices. So this lady's portfolio, this 86-year-old woman's portfolio, is down about 15%. And that should never happen. It should never happen. Now, unfortunately, here's the situation. She doesn't think that she cannot be invested. She doesn't understand that having monies in cash is preserving her capital as opposed to having it invested and risking the loss. You know, when you're 80-something years old, I guess you get set in your ways to some extent. But unfortunately, I think what's happened here is the fact that Wall Street has done an incredibly good job on everybody out there training you to stay invested. It's just like Pavlov's dog. Remember that story from your psychology classes? Pavlov's dog salivated every time the bell rang, even though he didn't get the biscuit. Well, Wall Street's done the same thing to you. They've taught you over time you've got to stay invested, when the fact of the matter is you're not always going to get the biscuit. Understand this. Cash can be a position. It is a position in a down market. You know, if you preserve your capital so that you can have money to reinvest later down the road at cheaper prices, you're going to more than offset sitting in a cash position. Now, I've got some great ideas for you. Why wouldn't you consider taking some of this money and let's talk about putting it in an indexed annuity program? Why an indexed annuity? It's absolutely safe. And in market environments like this, it's going to preserve your capital, and then it's going to turn around when the markets go up and give you a decent return. I've got an indexed annuity right now by a major insurance company that is absolutely a household name. I want you to listen to this. I found out this morning its index, it's a proprietary index that this company has, is up 6.9% since December, and the S&P 500 since the 1st of December is down about 11%. Now, wouldn't you like to have something like that in your portfolio to offset the risk ahead? If that sounds like something you want to learn more about, give me a call at 336-391-3409, and let's talk about it. And I guarantee you'll know the insurance company that I'm talking about. It's an A-plus rated company. In fact, a lot of people have been whistling their theme a lot lately. Does that give you a hint? Oh, well, onward and upward. All right, so onward and upward then. Let's sit down and have that chat. I'll tell you what I want to do for you. And I do this, I'm not going to charge you a penny for it. There's no obligation on your part, but I want you to have the facts. We're going to sit down and take a look at what you're doing. We're going to do a written retirement income plan, which is going to include a Social Security optimization report. And yes, there's still things that we can do to optimize your Social Security. You know, we've been having workshops this past week and talking about the changes that occurred to Social Security. Some things were eliminated. There is a very short window of opportunity for some of you. There's a longer window of opportunity for others, but there are still things to do. We're going to blend that in together in one report. We're going to also show you ways to take distributions in retirement that are tax efficient. There's ways that you can do that don't hit your Social Security tax brackets, and we love to be able to share that information with you. So give us a call at 336-391-3409. It's going to take maybe an hour, hour and a half of your time, and I promise you it's a low-pressure situation. Well, thanks for joining us today on the Wealth Guardian Show. My name is Doug Ray, and this is 94.5 WPTI, the Piedmont's News Talk and Sports Station.